All right, good people. Thursday Q&A video, but it's Friday morning. So before I tried to record this video last night, I did sit down on the couch for a little bit to just rest my eyes, so to say. And needless to say, my ass rested all the way through the night. So hitting you with the Thursday Q&A video here on Friday morning, and then as always later this evening, I'll be hitting you with the weekly recap. An interesting week for the market, so we certainly got a lot to discuss tonight. But for this morning, though, for the Q&A video, did get a lot of questions this week through Instagram, through Twitter, through email, a couple carrier pigeons. Mainly the two kind of consistent revolving questions here. One, when do we know the bottom is in? Two, how to trade this volatile market. So I got some opinions on both there. And as far as that first question is, when do we know the market is put in a bottom? Hell if I know, right? Trying to call the exact bottom is tough. Practicing patience and waiting for a couple of key things to unfold, that's a little bit easier. So, one of the first things I'm going to focus on is just simply the volatility index. And bear with me here as Thinkorswim is just being its typical self, nice and slow. So, how about them Celtics? All right. So, taking a look here at the volatility index, the VIX, obviously, we're getting a little bit of a pump here as of late, so it's a simple recipe. Big pump in volatility, you're going to see some selling pressure in the market. So looking at VIX here in the structure of the daily squeeze, it's trying to fire to the upside. As long as this continues to pump, it's probably a pretty fair bet that we ain't putting in the bottom quite yet. What I'll be looking for to confirm that is for VIX to start trading back under its daily 21 EMA. VIX under the daily 21, it's usually pretty smooth sailing for the market. Now, interesting here, volatility, let me clean up the charts just so I can give you a better view. But I think this is really important, and this could be a little bit of foreshadowing of, the next week to 2 weeks here in the market. More often than not, if we throw up the Keltner channels and we measure 2 ATR from the 21 EMA, more often than not, all we get from VIX is a big spike through the Bollinger Bands. We run 2 to 3 plus ATRs. More often than not, after that, it just typically dies right back down. So you got plenty of examples here, and you can spend a couple of minutes looking through the chart. That's typically all we get. Big ugly flush in the market. You got folks panicking, everyone's catching a spanking, but then VIX dies right back down, and typically the market is right back to business. Now, of course, last year was a bit of an anomaly with the pandemic, but in your just kind of typical day-to-day market, so to say, that tends to be it for volatility. So either, we're going to basically see VIX dive back down from here, and this is the end of it, and the market can start putting in the bottom and working higher, or we're going to see, one more big pump for volatility, one more ugly flush for the market, and then things die down, or, which I think is very unlikely, VIX just continues to explode here, and the market just really gets pummeled. So I think one of the first two scenarios is more likely. But before we're calling for a bottom, you need to see volatility die back down. So that's kind of my first golden rule. I'll take quick little, 1 to 2 day swings, playing reversion to the mean trades, which I'll talk about in a second. But before I'm kind of loading up and dipping my toe in the water for those bigger 30, 60 to 90 day swings, not until VIX is back under that 21. Another important thing I focus on is just the structure of the indexes themselves. Typically, or always, when the S&P 500 or the Qs are trading under their 21 period EMA, there's the potential for certainly some more downside. So I'm not trying to necessarily catch the bottom. I'm just working from a simple checklist of things that I want to see unfold over the next handful of days to weeks. That'll then give me a better sense that we've kind of brushed off all this bearish momentum, and we could be back to business. And I need to see the S&P 500 and the Qs trading back above their daily 21 EMA. When we're under the 21, you're going to get these, quick bounces back to it, but unless we're closing above it, there's typically more downside to come. Once you can start closing back above that 21, the market's got a much better probability of starting to work its way back to the upside. So for the SPY here, we're going to need a pretty good bounce and then some solid closes back above the mean for me to say, hey, I think we've seen the end of the selling pressure. And if you look at the weekly chart for the SPY, you got the big weekly 21 EMA, which I think is a key level of support in this market. The Qs, they're currently testing their weekly 21. So I do think as long as we're not above the daily 21, there's a little bit more potential downside for the S&P here to test that weekly 21. So I'm using the daily mean as a big gauge of support, really just a big gauge of market structure, so to say. If we look at the Qs here, so we did get the reversion all the way back to the weekly 21, and I think on a weekly basis, as long as we're closing under the weekly 21, and obviously we're under the daily 21 for the Qs, as long as we're under both of those moving averages, there's more room for downside. So I can't be calling for a bottom in the Qs here unless we're closing today back above the weekly 21 EMA. Otherwise, there's a potential for a little bit more slip inside. So, for me, it's just kind of approaching this idea of trying to, I hate using the term catch the bottom, but it's trying to, go about the idea here that potentially this is a nice pullback for the market. We're still in a very bullish trend, and this could be one hell of an opportunity to start putting some swings on. Approaching that potential idea, I want to work from this checklist. I don't need to get in here at the exact bottom, should this be it, because I think there's more than enough time in the world to play the move back towards the highs. So practice a little bit of patience, have your focus list ready as always, but for volatility here, as long as we're above the daily 21, hold your horses maybe a little bit. Maybe you kind of slowly work your way into some swings with, nice small position sizing. But that's the checklist. Until VIX is back under the 21 on the daily chart, and until the indexes are closing back above their daily 21s, I think there's more potential for downside. So until we see those things taking shape, I think it's tough to call for a bottom necessarily right now. So for the second question of the week, how do you trade this volatile market? A lot of this has to do with the indexes being under the 21. When we're above the 21, and let's just take a bigger picture look here at the Qs, it's smooth sailing, right? You wait for the dip to the 21, you take a couple long positions, and you profit on that 2 to 3 ATR move off the mean. You lock in gains, you pull back, you get long, rinse and repeat. It's basically the same game with a little bit more volatility and a little bit more quickness once the market is under the 21. The same rules apply. We're typically going to move 2 to 3 ATRs under the 21 before you get a vicious rally right back towards it. And if we fail to close above it, we typically get rejected and we roll another 2 to 3 ATR to the downside. At that point, there's a growing probability you're going to get a bounce right back to the 21, which you can see is exactly what happened this week. We failed to close above it. You make another 2 to 3 ATR move to the downside. So this concept of reversion to the mean, and I'm looking forward to cover it in tonight's video, we've had a pretty killer week here with these short-term trades. Shorting the market on the rejection of the 21, booking the short gains, and then going long on the move back towards the 21. The major thing to keep in mind here, in volatile markets like this, they can hand out so much pain. This is important. For the same reasons, it's a pretty bad idea to be loading up on long positions and buying calls when the market is 2 to 3 ATR above the 21. It's a pretty crappy idea to be trying to short and buy a bunch of puts once the market is 2 to 3 ATRs under the 21. Once we're 2 to 3 average true range moves away from the mean, it doesn't mean we can't continue to move in that direction. It just means there's a growing probability that sometime soon you're going to revert back to the 21. So for that reason, we want to look to try to play the rally back to the 21. And if we're not closing above the mean, you're locking up those long gains and looking to short the rejection for another 2 to 3 ATR move to the downside. So I'll get into detail in these tonight, but we're looking at the market. Last Friday, we're extended to the downside. Everyone's leaning short. Everyone's buying puts into the weekend. So we sold the put credit spread on Google, and then early in the week on Monday, as the market is rallying back to the 21, Google made a nice pop. So we sold the put credit spread, or we bought it back rather, for 50% of max profit. We get the reversion to the mean, we get rejected, so we sold a couple of call credit spreads on the QQQ, on the NDX, a couple on Amazon, playing the move 2 to 3 ATRs back to the downside. So really, it's just a little bit quicker because things are moving fast and you get a quick reversion to the mean, a quick fade, a lot of kind of violent back and forth. But it's the same kind of concept and the same rules that we do want to take to a market that's trending to the upside. Get long at the mean, or rather take your positions at the mean, and then take your profits once we move 2 to 3 ATRs in the opposite direction. At that point, you can play the move back to the 21 and then just rinse and repeat. So, certainly could see some more downside from here. Would I want to be short right now? Absolutely not. And if I was short, I'm probably booking profits right here because there's a growing probability you get a ridiculous rip back towards a 21. So there's the checklist of things to focus on. If we're trying to gauge when is mama market put in a bottom, volatility index needs to be back under that 21. I need the indexes back above their daily 21. And until that takes place, short the rejection of the 21, go long the rally back to it. I'll talk to y'all in tonight's video.